In a quiet building in Washington, D.C., 12 people sit around a polished wooden table. They are not generals. They are not elected by anyone you know. Yet when they make a decision, stock markets tremble in Tokyo, currencies collapse in Buenos Aires, families in Istanbul watch their savings evaporate overnight. The Federal Reserve does not command armies. It does not invade countries. It does not drop bombs or send diplomats to negotiate treaties. But it controls something far more powerful than any weapon ever built. It controls money. And in a world that runs on dollars, that means it controls almost everything. Most people think the Fed is simply America's central bank. It is. But that title dramatically undersells what it actually does. The Federal Reserve has quietly become the central bank of the entire planet. That is not an exaggeration. It is not a conspiracy theory whispered in dark corners of the internet. It is simply how the global financial system works. The dollar is the bloodstream of international trade. Oil, gold, wheat, semiconductors, coffee, copper, lithium, all priced in dollars. When countries trade with each other, most settle those trades in dollars. When governments borrow on international markets, they often borrow in dollars. When central banks around the world store their reserves, the largest share by far sits in dollars. This means every time the Federal Reserve raises or lowers interest rates, it does not merely move American markets. It moves everything. Every economy on Earth feels the ripple, from luxury apartments in Singapore to struggling farms in Argentina. From tech startups in Berlin to crowded factory floors in Vietnam. The decisions made in that quiet room in Washington reach further than any army could march. But this did not happen by accident. The dollar's global dominance was constructed over decades through a combination of economic might, strategic maneuvering, and one fateful moment in 1971, when America broke the rules of the international system and somehow got away with it. The story begins in 1944, in a small resort town in New Hampshire called Bretton Woods. World War II was grinding toward its conclusion. Europe lay in ruins. Britain was financially exhausted. The global economy needed a new foundation, and the United States had emerged from the carnage with its factories intact, its cities unbombed, and its vaults overflowing with gold. America held roughly 75% of the world's monetary gold. So, a deal was struck among the Allied powers. The dollar would be backed by gold at a fixed rate of $35 per ounce. Every other major currency would peg itself to the dollar. In practice, this meant nations trusted the dollar the way they used to trust gold itself. The arrangement delivered stability, trade expanded rapidly, economies rebuilt from the ashes of war. The dollar became the global reserve currency. And the United States became banker to the world. For more than 2 decades, the Bretton Woods system functioned. Countries accumulated dollars, knowing they could exchange them for gold whenever they wished. International commerce flourished, but a problem was developing beneath the surface. America started spending far more than it produced. The Vietnam War drained hundreds of billions. Great society programs expanded at home. More dollars flowed overseas than there was gold to redeem them. Foreign governments grew nervous. France's President Charles de Gaulle called America's ability to print the world's reserve currency an exorbitant privilege. He did not mean it as a compliment. France actually dispatched a warship to New York Harbor to collect its gold. That was how seriously trust had eroded. By 1971, the math no longer worked. President Richard Nixon faced a choice: devalue the dollar against gold, a humiliating admission of failure, or sever the link entirely. He chose the latter. On August 15th, in a Sunday evening televised address, Nixon announced the suspension of gold convertibility. He called it temporary. It became permanent. Just like that, the dollar was no longer tethered to anything tangible. It became pure fiat currency, money by government decree, backed only by faith. Many expected the dollar to collapse without its golden anchor. Foreign leaders scrambled. Economists predicted chaos. But the dollar did not collapse. What happened next explains everything about the world we live in today. It was one of the most consequential bargains in modern history, and most people have never heard of it. Within 3 years of the gold window closing, the Nixon administration struck an agreement with Saudi Arabia. The details were kept quiet, never formally announced. But the essence was this: Saudi Arabia would price all its oil exports exclusively in dollars. It would take its vast petroleum revenues and recycle them into U.S. Treasury bonds. In return, America would guarantee Saudi security with military protection that continues to this day. The implications were staggering. Since nearly every nation on Earth needed oil to power its economy, and oil could now only be purchased with dollars, every nation now needed to stockpile dollars. It did not matter that the currency was no longer redeemable for gold. It was now redeemable for something arguably more essential: energy. The petrodollar was born. Demand for dollars became global and effectively mandatory. The United States achieved something unprecedented in human history. It could print the world's reserve currency at will. It could run enormous budget deficits year after year, decade after decade, and the world would still buy its debt because everyone needed those dollars anyway. The privilege de Gaulle complained about did not end in 1971. It grew exponentially more powerful. But the dollar's empire extended even further into territory few people understand. A parallel financial universe emerged called the Eurodollar market. The name is misleading. These are not euros. They are US dollars held and traded outside the United States, in London, Tokyo, Singapore, Zurich, Hong Kong, and countless other financial centers. When American corporations conduct business abroad, those dollars often end up in foreign banks. Those banks lend them out. New dollar-denominated loans are created. The process multiplies endlessly. Estimates suggest more than 13 trillion eurodollars circulate globally. Some researchers believe the true figure is far higher. Here is the strange twist. The Federal Reserve did not create this money and cannot directly control it. The Eurodollar system arose from private bank lending abroad, yet those offshore dollars remain bound to U.S. interest rates. They respond to Fed policy. When the Fed tightens, the Eurodollar system contracts. And when it contracts, economies dependent on dollar funding find themselves starved of the oxygen they need to survive. This is where the Fed's global power becomes viscerally real. When the Federal Reserve raises interest rates, the effects radiate outward within hours. Higher American rates mean Treasury bonds offer better returns. Global investors begin pulling capital from riskier destinations and parking it in the safety of American assets. Money floods out of emerging markets. Consider what this means for Turkey, Argentina, or Indonesia. Investors withdraw funds. The local currency plunges against the dollar. Imports become devastatingly expensive. If the country owes debts denominated in dollars, and many emerging nations do, those obligations become crushing burdens. A loan that seemed manageable suddenly threatens to bankrupt businesses and governments alike. Inflation explodes. Central banks have no choice but to raise their own interest rates, even if it destroys local growth, just to halt the hemorrhage. Follow the Fed or watch your currency disintegrate. Those are the only options. In 2013, this dynamic revealed itself in spectacular fashion. The Fed did not even raise rates. It merely hinted it might begin tapering its bond purchases, a program called quantitative easing. That hint was enough. Markets panicked. Capital fled emerging markets at terrifying speed. The currencies of India, Brazil, Indonesia, South Africa, and Turkey crashed. Billions of dollars evaporated in days. The episode became known as the taper tantrum, all because of words spoken in Washington. Not action, just words. The Fed's power lies not only in what it does, but in what it might do. Markets move on whispers. Economies rise and fall on suggestions. And here is the uncomfortable reality. The 12 voting members of the Federal Open Market Committee have no legal obligation to consider global consequences. Their mandate is purely domestic: price stability and maximum employment in the United States. What happens in Jakarta, São Paulo, or Lagos is officially someone else's concern. Yet even as the Fed squeezes the world, it sometimes extends a lifeline. The 2008 financial crisis threatened complete global collapse. The immediate danger was not merely toxic American mortgages. It was a dollar shortage that gripped foreign banks. European and Asian institutions had borrowed heavily in dollars. When panic struck, those loans needed refinancing. Nobody wanted to lend. Dollar liquidity vanished. The entire financial system began seizing. the Fed intervened with an extraordinary measure, currency swap lines. Central banks in Europe, Japan, Canada, and elsewhere could borrow dollars directly from the Federal Reserve. The Fed essentially became lender of last resort, not just for American institutions, but for the entire planet. Without those swap lines, the 2008 crisis would have been catastrophically worse, possibly unsurvivable in its existing form. The fact that the Fed had to rescue foreign banks proved something profound. The global economy depends on one institution's willingness to flood the world with dollars during emergencies. The Federal Reserve was not merely influencing the international system, it was saving it. Then came quantitative easing on a scale previously unimaginable. After 2008, and again with even greater force during the pandemic in 2020, the Fed pumped trillions of dollars into financial markets. It purchased government bonds by the hundreds of billions. It bought mortgage-backed securities. Its balance sheet, which stood around $900 billion before the financial crisis, ballooned past $8 trillion by 2022. Money creation on a scale never witnessed during peacetime. That money did not stay within American borders. It spilled across the globe. Investors desperate for returns in a world where U.S. interest rates hovered near zero pushed into riskier assets everywhere. Stock markets soared from New York to Mumbai. Real estate prices surged from Toronto to Sydney to Berlin. Cryptocurrencies rocketed from obscure experiment to trillion-dollar phenomenon. Emerging market bonds were snapped up despite questionable fundamentals. Asset prices around the world detached from underlying economic reality, all because of money conjured into existence by 12 people in Washington. The consequences revealed a hidden wealth transfer most never noticed. That flood of liquidity was magnificent for anyone who already owned assets. Property owners watched home values double. Stockholders watched portfolios surge. The wealthy became spectacularly wealthier. But for everyone else, the story differed. Wages failed to keep pace. Rents climbed beyond reach. The cost of everyday necessities rose steadily, quietly. The Fed engineered a redistribution from those holding cash and earning wages to those holding assets and collecting returns. It widened inequality not just in America, but globally, without anyone ever casting a vote. More recently, the Fed's influence has assumed an even more explicit form. The dollar's dominance gives the United States a weapon no other nation possesses, the ability to sever adversaries from the global financial system entirely. Through SWIFT, the international banking messaging network processing trillions daily, America can lock countries out of international commerce with the flick of a switch. Russia discovered this in 2022. Following its invasion of Ukraine, Russian banks were expelled from SWIFT. Even more devastating, Russia's central bank held over $300 billion in foreign reserves, much of it in dollars and euros held abroad. Those reserves were frozen instantly. Money Russia believed it owned became unreachable overnight. Financial warfare without a single bullet. The sanctions aimed to punish aggression, but they broadcast a message to every nation watching. Your dollars are only yours as long as Washington permits. Your reserves are safe only until America decides otherwise. This moment altered calculations across the globe. Nations that accepted dollar hegemony without question began asking uncomfortable questions. If reserves can be frozen on political grounds, can the dollar truly be trusted? If SWIFT access can vanish overnight, is the dollar-based system actually safe? For a growing number of governments, the answer increasingly is no. Central banks worldwide began accumulating gold at record levels. In 2022, official gold purchases exceeded 1,100 tons, the highest in decades. The surge continued through 2023. Not because gold pays interest, not because it is convenient. Gold is heavy, difficult to store, impossible to spend directly. But gold cannot be frozen by a foreign government. It cannot be sanctioned. It sits in a vault under sovereign control, and no external power can declare it off limits. Gold became insurance against dollar weaponization. Simultaneously, China accelerated efforts to internationalize its currency. Beijing struck agreements with Brazil, Saudi Arabia, Russia, and others to settle trade in yuan rather than dollars. Russia shifted transactions toward yuan and other non-dollar currencies. The BRICS nations, Brazil, Russia, India, China, South Africa, and a growing roster of new members, launched discussions about alternative payment networks that could bypass American control entirely. For the first time in generations, genuine momentum toward de-dollarization emerged. But here is what headlines often obscure. Despite all this, the dollar remains dominant by a wide margin. It still constitutes roughly 58% of global foreign exchange reserves. The euro sits in distant second place. China's yuan accounts for less than 3%. Global trade still flows through dollar-denominated arteries, and every proposed alternative carries serious drawbacks. China's yuan operates under strict capital controls. Investors cannot move money freely in and out, rendering it unattractive for reserve holdings. The euro is backed by economies burdened with structural problems and questionable debt sustainability. Gold works for reserves, but not for daily transactions or electronic commerce. No clean, obvious replacement waits in the wings. The de-dollarization trend is real and accelerating, but it remains slow. The Fed's empire is not crumbling overnight. Yet the cracks are visible now for the first time in decades, and cracks, history teaches, have a tendency to spread. This raises a question rarely addressed in mainstream conversation. What happens if the dollar genuinely loses its throne? History offers uncomfortable answers. Every reserve currency in the modern era eventually faded. The Dutch guilder dominated global trade for a century before yielding to the British pound. The pound reigned longer, backed by an empire spanning the globe, until that empire weakened and the dollar rose to replace it. The dollar's supremacy has now lasted approximately 80 years. Some analysts argue America's economic fundamentals and military power suffice to maintain dominance for decades more. Others detect signs of decline everywhere: unsustainable debt trajectories, political dysfunction, over-reliance on financial engineering rather than productive investment. If the dollar fades as primary reserve currency, consequences for America would be profound. Without perpetual global demand for dollars, the government could not sustain current deficits. Borrowing costs would spike. Interest rates would rise. Living standards built partly on the privilege of issuing the world's money would erode. For the rest of the world, dollar decline could prove liberating or catastrophic, depending on whether any stable alternative emerges. There is something almost eerie about how little most people comprehend this machinery. The Fed sets rates that shape mortgage payments in Mumbai. Its decisions determine whether factories survive in São Paulo. It moves markets from Frankfurt to Seoul with a single carefully parsed sentence. Yet for ordinary Americans, the Federal Reserve remains a vague institution, glimpsed only when inflation flares or recession threatens. The reality is far larger and stranger. The Federal Reserve is the most powerful unelected body on earth. It requires no armies. It demands no invasions. It writes the rules of global money. And as long as the world runs on dollars, the world runs through Washington. Every transaction, every loan, every reserve account links back, directly or indirectly, to decisions made by officials most voters could not name. The question is whether this power is permanent or borrowed. Petrodollar arrangements that sustain the system are aging. China grows bolder. Gold is returning to favor among central banks wary of what comes next. And every time America weaponizes the dollar, every time it freezes assets or severs access, it provides another nation a reason to seek alternatives. The dollar's empire is not collapsing, but the ground beneath it is shifting. And if history teaches any lesson, it is this: financial power, like all power, does not endure forever. The guilder fell. The pound fell. There is no cosmic law exempting the dollar from the same forces that humbled every reserve currency before it. Most people will never sit in those quiet rooms where these decisions unfold. They will never vote for those who wield this authority, but those decisions will find them nonetheless. In the rent they struggle to pay, in the savings they watch shrink, in the jobs that appear or vanish. All of it connects to a system designed decades ago, maintained by figures few will ever encounter, and enforced not by weapons, but by the invisible, relentless logic of money. The Fed does not control the world through force. It controls the world through necessity. And that may be the most durable form of control there is.